Did you know that a developer has recently secured a $61 million loan for a mixed-use project in Orlando? This significant financial move showcases the dynamic nature of the commercial real estate market. Welcome to the Commercial Real Estate Insights Podcast. I'm your host, Steve Hamoen. Let's get right to it. In a noteworthy development in the commercial real estate sector, a developer has secured a substantial construction loan to advance the yard at Brookhaven mixed-use project in Lake Ivanhoe, Orlando. This project, which has been long anticipated, is now nearing readiness for leasing thanks to the financial backing. The loan is expected to facilitate the completion of this mixed-use development, which is set to become a vibrant part of the Lake Ivanhoe community. In one of the most significant transactions of the year within Pierce County, the Alderra Apartment Homes, a 200-unit complex located in the Puyallup area, has changed ownership. This development, which was originally constructed in the early 2000s, is an indicator of the competitive nature of the multifamily real estate market in the region. The deal underscores the continued interest in multifamily properties, even as the number of new developments under construction remains limited. The transaction highlights the robust demand for established apartment complexes, which offer immediate rental income and are seen as stable investments. This demand is driven by a shortage of available multifamily projects under construction, pushing investors to seek existing properties to meet their portfolio needs. The Alderra Apartment Homes deal is a testament to this trend, reflecting a broader pattern seen across various real estate markets, where established multifamily assets are highly sought after. In the Kitchener-Waterloo area, similar trends can be observed, with multifamily properties experiencing high demand and limited new construction. This situation mirrors the American market, where investors are keen to acquire existing properties to capitalize on the immediate returns they provide. In both regions, the multifamily sector remains a cornerstone of the commercial real estate landscape, attracting significant investment interest. Competition is intensifying in the retail real estate market as buyers from various sectors, including private capital and institutional groups, aim to capitalize on the sector's robust fundamentals. According to JLL's second quarter Retail Market Dynamics report, the national retail investment landscape was described as resilient in the first half of 2025. Transaction volume reached $28.5 billion, marking a 23% increase over the same period last year. This figure surpasses the long-term historical average of $27.7 billion for the first 2 quarters of the year, as reported by the brokerage firm. The data encompasses all transactions of $5 million and above for all retail asset subtypes. In the Midwest, retail investment sales brokers report a significant influx of capital into the sector and heightened competition from institutional investors. Michael Nider, a senior director with JLL Capital Markets in Chicago, notes an increase in liquidity from both equity and debt perspectives. Transaction volume is up in terms of deal volume and the number of transactions, while cap rates are compressing. Grocery-anchored and unanchored retail assets remain efficiently priced, but power center cap rates are compressing more rapidly from their elevated levels. The spread between grocery-anchored cap rates and power center cap rates has narrowed significantly, moving from 166 basis points in 2023 to around 80 basis points today. Brett Berlin, Senior Vice President with Quantum Real Estate Advisors, Inc., indicates that demand from buyers has increased significantly over the past 12 to 18 months. Despite the current interest rate environment, sellers have adjusted to new valuations, leading to a notable uptick in sales activity. At its September meeting, the Federal Reserve implemented a quarter-point cut to the benchmark rate due to a slowing labor market, marking the first rate cut of the year. The federal funds target range now stands at 4 to 4.25%. This rate reduction, along with the narrowing bid-ask spread, has facilitated more deal closures. Scott Wiles, Senior Managing Director of Investments with Marcus & Millichap's Cleveland office, explains that the bid-ask gap has narrowed as sellers accept current cap rates and interest rates slightly recede, allowing buyers to stretch upward on price due to cheaper debt costs. With increased capital in the market, competition among buyers has intensified. Some investors now cite a lack of available products for purchase. Nieder highlights that the challenge to transaction volume is more related to owner motivation than pricing. Public REITs have closed $460 million in Midwest acquisitions year to date, and there is an uptick in activity in secondary markets due to robust competition in primary markets for institutional quality assets. Institutional investors are drawn to the Midwest for its portfolio diversification, low climate risk, and attractive yields. Quantum Real Estate Advisors, Inc. recently arranged the sale of Eola Crossing, a 14,238 square foot retail center in Aurora, Illinois, sold to an all-cash private buyer for $2.8 million at a cap rate of 7.25%. Christian Williams of CBRE in Oak Brook, Illinois, affirms that retail fundamentals remain strong, with more institutional capital active in the market post-COVID. However, the market is still dominated by private capital investors, including family offices and private equity funds, which accounted for about 70% of transaction volume in the Midwest during the first half of 2025. The demand for retail properties, especially those with smaller tenants, remains high, with transactions closing quickly. Scott Wiles notes that retail properties with tenants under 5,000 square feet command the most demand, as buyers look for opportunities to raise rents. Recently, Wiles brokered the sale of Crocker Commons, a newly constructed strip center in Westlake, Ohio, featuring tenants like Shake Shack and Verizon, which sold at a low 6% cap valuation, reflecting the premium value of top-performing strip center assets even in secondary markets. In-N-Out Burger is making strategic moves to expand its footprint in the Pacific Northwest by acquiring a 71,000 square foot industrial property in Gresham, Oregon. This acquisition marks a significant step for the California-based drive-thru burger chain as it looks to strengthen its presence in the Portland area. The property, located at 18205 to 18365 Northeast Sandy Boulevard, spans 4.63 acres and was part of a transaction brokered by Cushman & Wakefield, as reported by the Portland Business Journal. The newly acquired building is part of the Portland Portal 3, an industrial and warehouse development that was completed in 2024. This facility will serve as a crucial hub for In-N-Out's operations in the region. Since 2019, In-N-Out has been gradually expanding around Portland, having opened locations in Kaiser and Ridgefield, Washington, both within an hour's drive of the city. This strategic acquisition is expected to support the company's plans to further penetrate the Portland market. In-N-Out has filed permits or plans for additional locations near Portland International Airport, as well as in Vancouver, Beaverton, and Hillsborough. The expansion efforts reflect the company's commitment to establishing a strong presence in the Pacific Northwest, a region that has shown growing demand for the iconic burger chain. As In-N-Out continues to grow its operational capacity in the area, the Gresham property will play a vital role in facilitating distribution and logistics for future store openings. In recent news, a co-living building near the Walter E. Washington Convention Center in Washington, D.C., is facing foreclosure. This 67-bed property, which was marketed for sale in 2024, unfortunately did not find a buyer. The building's predicament highlights the challenges faced by some segments of the real estate market, particularly in urban areas where co-living spaces have gained popularity. According to the Washington Business Journal, the property is now headed to the foreclosure block, marking a significant turn of events for this type of housing in the capital. The co-living model, designed to appeal to young professionals and those seeking affordable urban living, has been both lauded for its innovative approach and criticized for its sustainability amidst changing market conditions. The current situation with the D.C. property may serve as a cautionary tale for other cities considering similar developments. As the real estate market continues to evolve, stakeholders will need to assess the viability of co-living spaces and their impact on urban housing landscapes. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.